What is a valuation cap in convertible notes? Imagine you're investing early in a startup and want to make sure you get a good deal if the company grows quickly. That's where a valuation cap comes into play. When founders and investors agree on a convertible note, they often include a valuation cap to set a maximum company value for converting debt into equity. This cap acts like a ceiling, ensuring early investors get a better price per share if the company's valuation skyrockets later. Convertible notes are a type of short-term loan that turns into shares during a future funding round. Instead of setting a fixed price for shares now, investors get the chance to convert their debt into equity later, usually at a discount or with a valuation cap. The valuation cap is a key term because it determines the highest valuation at which the note will convert into shares. If the company's valuation at the next round is higher than the cap, the note converts as if the valuation was at the cap level. For example, if an investor's note has a valuation cap of $3 million and the next funding round values the company at $6 million, the note converts at the $3 million valuation. This means the investor gets more shares for their money because they are effectively paying a lower price per share. If the investor invested $100,000, they could end up with twice the ownership percentage compared to converting at the higher valuation. From a founder's point of view, the valuation cap is a way to reward early investors for taking on more risk. A lower cap means investors get more shares, which can lead to more dilution for the founders later on. A higher cap reduces dilution but might make the investment less attractive to early backers. It's important to strike a balance that encourages investment while protecting the founder's ownership. In practical terms, the valuation cap is usually set during the fundraising process and included in the convertible note agreement. It works alongside other terms like a discount rate, which also gives investors a better price at conversion. Together, these terms help make early-stage funding more appealing to investors while giving founders some control over future ownership. Understanding how valuation caps work helps founders negotiate better deals and plan for future funding rounds. It's a way to ensure early investors are rewarded for their support without giving away too much ownership too soon. When planning your funding strategy, think carefully about what cap level makes sense based on your growth expectations and the amount of dilution you're willing to accept.